Hi, can you guys hear me? Great. So thank you for coming to the real estate panel. The aim of this panel is really to give you guys an overview of the commercial real estate industry, ongoing trends, and to kind of talk about the internship process. My name is Ashley Coxum. I'm the Senior Program Manager for Real Estate. And today we have Khalid Rashid, who is at Clarion Partners. We have Brian Kam, who's at KKR Real Estate. And we have Stephen Dupree, who's at PGIM. So we'll get started. Can you guys hear me? Okay, perfect. So we'll kind of start off and have each of the panelists present kind of their career and how they've gotten to this point. So can you start off, please? Yep.
Hello? Okay, well, good morning or good afternoon. I'm pretty excited to be here today. Former SEO intern, I was in your seat a while ago. I won't tell you exactly how long ago, but welcome, great program, and I suspect that you guys got a lot out of it this weekend, or this summer. For me, I've been at Clarion Partners for 10 years now. I started at Clarion in the Los Angeles office after graduating from business school. And for me, I've been fortunate to have 3 different careers over the last 10 years. I started off in the asset management group, focused on apartments, office, industrial, and retail. So really got a broad-based introduction into real estate. And from there, moved to acquisitions. So spent a bit of time there on the transactional side. And so for the last 4 years, I've been focused on the portfolio management side. And what that is I'm the direct liaison between our clients, the capital sources, our separate accounts, and all the internal resources that we have. And so I'm charged with making sure that we execute on the strategies that we've laid out with our clients.
Hi, everyone. My name is Brian Kam. I am a principal in the real estate acquisitions group at KKR. To make your head spin a little bit, my twin brother is actually sitting in the back. He's visiting me this weekend. So if you run into someone who looks very similar, that's him. Say hi. So maybe I give you a little bit about the history of KKR and how the real estate group got founded there, and then I'll tell you a little bit about how I ended up in real estate. So KKR, really for the longest time, last 30 years, was a corporate private equity firm, only did big leverage buyouts of large companies, which is what it was known for. And roughly 10 to 15 years ago, Henry and George, who were the founders of the firm, made the decision that we had to diversify, that we wanted to have more conversations with management teams beyond just sort of corporate leverage buyouts, and we wanted to be able to do a lot more things. And so the decision was made roughly 7 years ago to start a real estate group at KKR. So our business is fairly new, and frankly, when I joined 4 years ago, I was employee number 7 or number 8. We've since tripled in size, which has really been an incredible journey. And that's sort of how the business came to be founded at KKR. Today we invest out of a $2 billion opportunistic fund called Real Estate Partners Americas, which is a which is your conventional value-add opportunistic fund. Your typical buy, fix it, and then sell it type real estate fund that really targets opportunistic and value-add rates of return for our investors. And that's principally the group within which I work. So a little bit about my journey to real estate. I think when you ask most people how they end up in real estate, typically for folks like yourselves in college, it's certainly not the sexiest group, right? Like everyone wants to end up in TMT or consumer retail, handbags and things, right? And real estate really isn't that popular of a choice. So I think you'll find that most people who end up joining real estate have some sort of personal connection to the industry. And my personal connection was growing up roughly 15 years ago when I was still in high school. My mom had retired at the time. And after she retired, she was sort of bored and looking for things to do. This is back in Hong Kong, where I'm from originally. And so she started going to buy apartments and in really old walk-up buildings and going to sort of renovate them and rent them out. And so as a 15-year-old, I would go along with her, not knowing anything, to these apartments, and that's sort of what got me really interested in real estate to begin with. So coming out of college, I knew that that was what I wanted to do. I have a relatively conventional path, not unlike the one that is before you folks today. I spent roughly 2.5 years doing real estate investment banking at Goldman Sachs, and then joined the private equity group, the real estate private equity group at KKR roughly 4 years ago. At KKR, I spend most of my time focused really on a couple of sectors. Multifamily is one. I spend a lot of time on student housing, and I spend a lot of time in hotels.
Hi, everyone. My name is Stephen Dupre. I'm with PGIM. We are the asset management arm of Prudential. And in the PGIM suite of businesses, there are fixed income equities. We have 2 real estate businesses. We have a mutual fund business. And then we have a global partners group that has a lot of workings around the globe and different types of assets. The 2 real estate groups that we have are known as PGIM Real Estate and PGIM Real Estate Finance. They both have, they work across all real estate assets, so multifamily, senior, industrial, hospitality. They fundamentally do 2 different things. PGIM Real Estate Finance is providing capital for real estate projects around the globe, and PGIM Real Estate is taking capital from institutional investors who are interested in making a play in different types of real estate assets. So a really good example was a retirement fund in California recently came to us, and they were interested in getting into the hospitality market. So they partnered with us to look at some opportunities, and over the span of time, we identified those opportunities for them, and that's how we partner with the institutional client. Our offices are all over the domestic United States. Some of the teams are highly specialized. So in California, for example, we have a team of investment professionals in San Francisco who do nothing but think about the wine industry. So it is a very tangible asset that you can go out and you can tour the vineyards and you can get to know the clients, you can test the grapes. So when I came into this industry many years ago, one of the things that fascinated me most about real estate is that it is an asset that you can touch, where if you were working in fixed income, you can't really get out and tour the product like you can in real estate. So that's one of the things as I'm meeting with prospective students and really selling the opportunity that's available in real estate is that you can get out and you can really see it, and it becomes real to you, and the work that you're doing impacts the lives of many people, particularly if you're working in senior housing or multifamily housing. In California, where I'm from, we have it's a pretty dire situation in some of the major cities in terms of housing, and companies like mine are going out there looking for solutions for people to provide them with sustainable housing. My role at Prudential, I'm the director of inclusion and diversity, so I get to work with organizations like SEO to identify our incoming group of talent. We have a number of different programs, such as a summer internship program where you spend 10 weeks with a team. Beyond that, you could potentially find yourself working as an investment analyst. It's a 3-year program that is designed to give you all of the experience and the skills that you'll need to be successful as an investment professional in real estate. And then you can move on beyond that and start to work within the groups, and perhaps you start out in senior housing, but you're really interested in what's happening in the agriculture space. You can make that leap as well. So there's a lot of rotation opportunities built within our model.
Okay, great. So each of you kind of touched on how you kind of found your pathway in real estate. I guess when we're kind of pivoting and talking about the theme, why real estate, I guess if you guys could touch on what do you think is attractive about commercial real estate versus maybe a more traditional career path, traditional finance career path?
I would say it's an interesting question because real estate can be traditional finance. You mentioned earlier, Prudential has a mortgage-backed securities group, right? So that's very traditional finance. And so the thing about real estate is you can go from traditional finance, selling CMBS debt, selling equities, dealing with REITs, all the way down to being an operator, someone that KKR would work with to reposition assets. And so the thing that I find unique about real estate is I still believe there's a bit of arbitrage in the market relative to your equity and debt markets. There's opportunities for you to go into a particular market, a sector, and actually effectuate change. That's what I really like about it. And you can put your stamp on an opportunity. For instance, we recently bought a 300,000 square foot vacant building in Southern California. It had been vacant for 4 years. So we came in with a strategy of fixing the building, changing it from a traditional building to a more creative-oriented building, redeveloped the courtyard. We had an acre between the parking structure and the office building, and we got a chance to do some very unique things. And going through that process of redeveloping that asset, repositioning it, it's leased up to 100% now. And so those are the kind of things that you can actually work through the life cycle of an asset and understand how to really be a catalyst for change, and I don't think you can do that in a lot of other industries.
Look, I would agree with Stephen. I think the awesome thing about real estate is it's something you can see and touch, right? And unlike other sectors where if you're in industrials, it's an abstract concept, right, of like widgets and machines and things. Real estate is something that impacts everyone on a day-to-day basis. And it's something that's very, very tangible. And part of that is there's a lot of travel, right? So you get to go see lots of different places, go to parts of the country that you might not otherwise. That's sort of one element of it. And I think the other element of it is, as Khalid said, it often involves some very complex repositionings that are really quite cool. So one of my favorite assets that I've worked on over the last 4 years is our fund in 2013 purchased a vacant office building in Waikiki in Hawaii, about a block from the beach. And obviously, there's not a lot of use for office buildings in Waikiki, so the thesis was really the ability to buy that vacant office building fairly cheaply. And then the business plan was to convert that office building into a Hyatt hotel. 4 years down the line, the hotel has finally opened through an extensive renovation that I spent a lot of time on. There's a retail component where we spent a lot of time repositioning that, getting Nordstrom's and Starbucks and all these national retailers into that box. That was honestly, a very cool project that I was able to see through fruition. The hotel opened 2 years ago, and it's something that's very tangible. It's very cool. For me, my interest in real estate is really just how tangible it is, and you got to work on really cool things that are you can see and touch on a day-to-day basis.
I think the most fascinating thing about real estate is the ability to transform. PGIM is part of Prudential, and we are headquartered in the city of Newark, New Jersey. And in the 60s, there was a flight of businesses and people from the city of Newark, which left the infrastructure hollowed out. And so in one of our funds, it is led by a team of impact investors. We started purchasing buildings in the downtown Newark area to convert that to housing. And that housing is given entirely to teachers, to many of the artists that perform on Broadway here in the city of New York. We saw an opportunity to give them housing, really beautiful housing, at a rate that is commensurate with their pay scale. So in the last 6-7 years, you've seen an influx of people in the downtown Newark area, and it is changing. There are stores like Starbucks that are moving in. We have a Nike store next to our global office, and you can see the transformation day by day. People are walking their dogs in the park. It has become a community, and that is one of the most fascinating things about real estate and the power to transform cities and towns across the country. So that's one of the things I'm most proud about my organization, is we really look for opportunities to give back to the communities where we do business.
Okay, great. And as we kind of, explore kind of demystifying commercial real estate, from your experience, what are some misconceptions that people have about working in the real estate industry versus what you've actually experienced? And I don't want to always defer to you first, so I'll let Stephen take that one.
Well, I think the question I get most often is I'm asked about the residential real estate market, which is not what
Exactly.
we touch. And I can offer no advice in that arena. So I think it's really just a process of educating on commercial real estate and what that is, and talking about the investment process, whether it be from a equity standpoint or a debt standpoint, which is where our two businesses are focused. So I think it's really just clarifying what type of real estate my firm is in, and speaking to that truth.
Brian, you have any comments on that?
Yeah, I think something that comes to mind, which is very similar, is when you tell folks that you work in real estate, right? The first question they ask is, "Are you like a real estate broker?" Right? And that's or do you lease apartments for a living? And obviously that's a fairly big misconception about the complex array of roles that there are in the real estate industry. And so to Stephen's point, I agree. It's it's a lot of education, speaking to folks about what you do that is different, and what you do that's really quite high level and really quite strategic. As opposed to sort of the nitty-gritty of apartment leasing and brokering and so on. But that's one of the big misconceptions when I talk to folks about real estate. Frankly, I think the role is at KKR I've been surprised by how much folks are interested in thinking strategically about investing, right? Because I think a lot of folks think it's bricks and mortars. But within our group, we are constantly looking at the macroeconomic cycle and thinking about what kinds of things that we want to be investing in, depending on the point in the cycle and what kind of investments provide attractive risk reward. And frankly, I think a lot of that is a lot more sort of investing focused than necessarily just purely real estate.
Yeah, and I'd agree with both Brian and Stephen. It's that institutional real estate side. I think a lot of people just think about brokerage, development, and things of that nature. But there's so many different facets of real estate. You can do everything, like I said, from trading equity, debt, all the way down to, again, being a developer for 4 apartment units or being a developer for the West Side Rail project. It's a very fascinating industry. But I think the one thing that I find is people don't really understand what happens on the institutional level as opposed to what happens on the more bricks and mortar day-to-day operational side of real estate.
Great. So I talk to students all the time, and it's kind of this demystifying real estate, and real estate has traditionally tended to lag as far as diversity and inclusion. So I guess I'll start off with you, Stephen, and you guys feel free to jump in. At this point in kind of the stage of the industry, why do you feel firms at this point are starting to tackle diversity head on?
So I think for us, it really started shortly after the financial crisis. There were a lot of the problems, or as we saw it, were part of a groupthink mentality. And so if you have a team of people who perhaps all look the same, all went to the same schools, and didn't have differing opinions or backgrounds, it created a scenario where perhaps poor decisions could be executed, and it would cost the firm money, reputation. So that was probably one of the business imperatives for us, to really think about how our teams are put together. Are we only looking at specific schools? Are we casting our nets really wide and trying to be very inclusive? So we started partnering with organizations in 2012 and 13 to help provide solutions. Then we started looking at the types of universities that we were consistently going to. I myself came from Baruch College. I know there's a lot of diversity and there are a lot of really smart and talented students at Baruch. And so I pushed back, why are we only going to University of Michigan? Why can't we include Baruch? It's in our backyard, and they have a really strong real estate program. So it was really having those conversations, influencing some of the senior leaders, opening up their minds, bringing in that talent at the entry level, and watching these young men and women shine and start to move through the organization, create their own reputation, and that really built the case for casting a wider net and building a more inclusive work environment. We still have a lot of work to do, but certainly the door is open, and we've seen the real tangible results of those types of activities and initiatives.
And I would say, you know, and he made a great point from one perspective, but I think it's great to see the pension funds, endowments, CalPERS, CalSTRS, PRIAs pushing for inclusion. I think, you know, SCO did a great job on the investment banking management consulting program. They've been doing a great job for 20 years, but there's always been a void on the real estate side. And it's phenomenal to see PRIA and SCO partner to create a similar platform that SCO provided for the investment banking and management consulting side. And I think we're going to continue to see the capital sources, those that provide capital to all of our institutions, push for more diversity and inclusion, because when you go to meetings, and it's always interesting when you're pitching new business, and one side of the table is very diverse and the other side is not. So we're seeing the pension funds push for a unified front, diversity on both sides of the table, not just on the side that's allocating capital, but also on the side that is actually managing the capital.
Yeah, look, I would say I think that I would agree with your comment, Ashley, that real estate continues to be an industry that has a lot of work to do in terms of diversity, and by that I mean, you know, in my experience, you know, meeting with, so our fund works with a lot of operating partners, so, you know, we typically don't execute on the business plans of the real estate assets that we're buying ourselves, because we're a relatively small group, but we typically work with partners all across the country who execute on those business plans. And what I found is that real estate on the two coasts, I think, tend to be pretty diverse in terms of folks in the industry. But, you know, the majority of the value of real estate, unfortunately, I mean, fortunately, doesn't sit in the two coasts. There's a lot of real estate value that sits in the middle of the country. And I think what I've personally found is that, you know, if you go to meet folks in real estate in Texas or in North Carolina, or, you know, a lot of these states that are outside the two coasts, which is where, frankly, our fund buys the majority of its real estate, it's still a place that does not have a lot of diversity, that is still, frankly, fairly male-dominated today, and frankly does not have a lot of diversity in terms of minority folks who are involved in real estate. And I think that, so I think it continues to be, you know, work in progress, and something that the industry really needs to work on. You know, I think the imperative for having more diversity in the industry is really two things, and both Stephen and Khalid mentioned them. One is you had the financial crisis, which was this huge washout of the real estate industry. A lot of people lost a lot of money. And part of that is just groupthink, which is something that we spend a lot of time talking about in our group, right? Which is, if you have the same folks sitting around the table with the same backgrounds and the same experiences, everyone tends to agree with each other and everyone tends to have the same viewpoint, which frankly led to a lot of things that happened during the financial crisis. And I think part of the push for diversity is getting people with different sets of experiences, with different risk tolerances around the table, and being able to make better decisions with different perspectives that will prevent something like the financial crisis happening again. So that's sort of one. And then to Khalid's point, there has certainly been a push from our institutional investors to have teams that are more diverse. And part of that is, a lot of our investors are pension funds, across the country with frankly very diverse underlying, folks. So these are teachers or firefighters or policemen who come from all sorts of places and all sorts of backgrounds, and those backgrounds tend to be diverse relative to the industry today. And so I think there's been a big push from those pension funds and institutional investors to have the funds that they invest in reflect the diversity of their underlying investors who we serve.
Great. And all three of you mentioned kind of the importance of your investor, kind of their essentially have the cash and are driving the ship. Just wanted to pivot slightly to kind of talk about kind of macro outlook. What direction do you feel your investors are typically moving at this stage in the cycle? So real estate is a very cyclical business, as many of we've talked about. The crash is kind of a marker in every real estate professional's mind, but what kind of behavior or whether it's market, property type, do you see investors kind of shifting into these days?
So would totally agree. I mean, the view within our firm is that it feels fairly late cycle, right? So you have been, you're 9 to 10 years you're 9 to 10 years into an economic recovery, and that would, by all historic measures, be a relatively long period of economic expansion in the United States, probably, if not the longest, the second longest period of expansion. And so I think the sort of consensus view within the real estate industry today is that it feels fairly late cycle. And so the kinds of things that that institutional investors are interested in, which are the kinds of things that our fund is focused on today, are really highly defensive sectors, and also sectors where you're betting on cash flow as opposed to appreciation. So where there's a lot of yield that makes up your return, as opposed to betting on property prices continuing to grow. And so what are those sectors, right? Those sectors are, we spend a lot of time today on student housing, which historically has been a pretty counter-cyclical asset class. So folks tend to go to school when the economy's bad and vice versa. We spend a lot of time in senior housing. So there is a pretty broad demographic trend of baby boomers who are aging, who will continue to fuel demand for senior housing. And we spend a lot of time in markets where we think that there's secular growth trends. So we spend a lot of time on the West Coast, where we think that there's real secular growth trends around technology and migration and population movement, et cetera. And then the last area we spend a lot of time in, and I would also, secular trends, I would put industrial in that as well, the tailwinds around e-commerce. And then lastly, we spend a lot of time on the multifamily sector, where because of the way you can finance transactions with agency financing, which is really cost effective, there's a lot of cash flow that's created, combined with secular tailwinds around household formation. So those are really the couple areas that we're focused on, and I think that's fairly consistent with what a lot of our peers are focused on as well.
Yeah, and I'd agree. It's pretty interesting if you look at the dynamics of the market right now. You talk to some people, they say there's no reason why this cycle can't continue to go for another 12, 36 months, but conventional wisdom would tell you that, something is going to happen or suggesting that there's a recession that could be coming in the near term. And if you look at certain market markers like transactional volume peaked in 2015, you look at office and retail, those are two sectors within the MPI. that have lagged the broader market. And so you are seeing signs of weakness in the economy right now. But like Brian said, industrial is one sector. It feels like there's almost been a sea change in that industry with e-commerce. And that's an area where we're continuing to spend a lot of time and focus on. We tend to take more of a build to core strategy. So we tend to build in markets and sectors that we believe in and hold on to those assets over the long term as opposed to buying those assets for extremely low yields. Another area that we're really focused on is some of the niche property sectors, your medical office, your senior housing, your student housing, and self-storage. And so we've backed away from, buying large office buildings in your gateway cities like San Francisco, Seattle, New York. And we're taking a more targeted approach to the investments that we make right now. And for product type like like industrial that we really like, again, instead of buying at extremely low cap rates, we're looking at building the core, building a portfolio, and holding on to it, and with the idea of holding on to it for the long term.
So I think to our equity business, they've taken a very conservative, defensive stance with where things are in the market today. I think they have pulled back in some respect and have focused in senior housing, industrial. On the flip side of that, our debt business, we aren't seeing any lack of demand for project financing, so we continue to expand and grow, particularly in the West, where we are currently working on a number of multifamily and senior housing projects up and down the California coast. So it's interesting in our business because it's oftentimes when equity is having a high peak period, debt is feeling the pain, and we're starting to see that shift now where equity is becoming more conservative and debt is seeing an expansion. So we see it almost as a seesaw. So if one is up, the other may be down a bit, but it counterbalances itself out. And that's why I think our unique model of having both a debt and an equity business works for us.
That's great. And there's been a lot of talk in the industry, kind of the rise of prop tech and technology. Typically, real estate is very much a brick and mortar business, very much a little bit lagging in the technology space. So I'm wondering your thoughts on how do you think technology may be a disruptor or a positive for the real estate industry? Each of you guys can jump in.
It's interesting I'll talk about it from the operational level. I think technology is making our industry more efficient and quite frankly more effective. I think it cuts out some of the unnecessary, some of the unnecessary consultants and operators. It allows you to be more efficient. One example is, VTS, I think is a technology that we're using. It makes our entire platform that much more efficient because at any time, anyone in our firm can look at what's going on in any one of our assets from a leasing perspective. You have wired score. You have a multitude of technology options that I think making our business on the operational side much more efficient.
Look, I think I'd agree with the comment that real estate tends to be an industry that lags in terms of using technology in a way that's effective. A lot of leasing is still done on pen and paper and so on. So it's certainly an industry where technology has the potential to be really quite disruptive. I think I'd bucket that into really two buckets. One is sort of technology that makes things more operationally efficient. So like whether that's better property management systems, whether that's systems that collate the way that or aggregate the way that you lease, things like that, which make operating assets much more effective. It's sort of that's one bucket where I've seen a lot of technology companies enter into real estate. The other bucket, which I think is potentially a little bit more transformational, is there's been a lot of talk around using big data to better make investments. So In our group, we've spent a lot of time thinking about, how do you find the next meatpacking district, or how do you find the next Brooklyn? Because by the time that Brooklyn is sort of cool and like has become the place to be, you've probably missed all of the real good real estate opportunities that are there, right? And so how do you use big data, whether that's things like Yelp reviews or like tweets and things like that, to be able to capture what is happening on the ground in terms of real estate before it happens. And that's frankly, I think, one of the areas that could be really, really interesting and could really make institutional real estate investors better investors than they are today, because there's not a lot of data around that kind of stuff.
Yeah, I absolutely agree with that. Data is really, I think, transforming the way that our investment teams look at the work. 2 years ago, we created a data analytics team that sits within the real estate business. So these are people who had probably zero interest in real estate prior to joining our team. So this is a real eye-opening experience for them, but they are truly the kind of firing the decisions that we're making in the last, I'd say, 12 to 14 months. So we're harnessing the power of big data to really pivot and move in a new direction. And I think there are also disruptors, like WeWork, for example. We're really following that model to see how it impacts the greater commercial real estate market, and is there or are there opportunities to leverage that for our businesses? We've certainly have lost some talent to WeWork because it isn't, it's an exciting new proposition. So we're looking at all of these disruptive technologies or new disruptive business models and trying to think about ways that we could either use it to our benefit or learn from it so we can compete against it in the future.
Okay, great. Well, I want to leave some time for question and answer, so I'll kind of ask a two-part, kind of just pivoting on interns and internships and new talent. So the two-part question is, one, if you could provide some kind of a profile of a successful intern that maybe has worked with you, that really kind of added value. And then for these lovely people, what are two actionable items that they could do to really kind of further explore commercial real estate?
On the first part, I would say, at this point in your career, you're not expected to be able to walk in and, underwrite a deal using Argus, cash flow models, really understanding valuation metrics. But I think at this point, being thoughtful in your approach, being very strategic, and being thorough, I think those are three areas that can help you in the beginning of your career. I think what you want to do is make sure that everyone within your organization identifies you as someone that has the capabilities, the aptitude, but more importantly, the potential to excel. And so, if you're asked to do the most minor task, be the best at it that you can be. And I think just, again, being thoughtful in your approach is critical, and just showing that you have the potential is huge. And the second part of the question, I would say read as much as you can about the industry. There are a number of different publications that give you in-depth updates on what's going on, transactions, who's doing what, who's raising capital, who's building new projects, who's acquiring. Is be as conversant in the industry as possible. So when you are at a networking event, when you are in a senior person's office, you can really talk fluently about the industry. So read as much as you can, but also network and meet as many people as possible. I will say, depending on the area of real estate that you want to go into, if you're considering development and some of the more, local facets of real estate, is really got to pound the pavement, get in front of as many people as possible to get your name, ringing through the entire organization. And so just be diligent, and just, again, show that you understand the industry and you understand what you're getting into, understand the different facets of real estate, understand the dynamics between being a developer, being on the acquisition side, and understanding asset management and other facets of the real estate industry, I think will help you go a long way.
Yeah, I totally agree with all those points. I would add, I think when I think about the interns that I've worked with in the past who have done really well, I think one of the most crucial skills or attributes is really to have curiosity, right? So, for our summer interns, we'll typically have them do a summer project. And typically we'll have that summer project be fairly open-ended. So, our interns will pick a city, so Boston or Charlotte or LA or wherever, and we'll sort of make it fairly open-ended. We'll say, give us an overview of that market, and then tell us what you think is interesting to invest in, which frankly is a pretty tall task for someone who doesn't have a background in the real estate industry. And a lot of being able to be successful at that is really curiosity, right? So like calling up and working with full-time folks to set up broker calls, to really, part of our summer intern experience is actually going to the market, which some interns may or may not have the experience of being able to do. But going to the market, walking it, trying to figure out actually, if this were my own money and I was investing it myself, what would I really be interested in investing in, right? And having the curiosity to be able to go explore different sectors within that market, and just thinking about what could be interesting. So really just curiosity and exploration. That's sort of one thing that I think in real estate is a particularly useful skill. And then, as it relates to getting into the industry and being prepared for that, I think, having a demonstrated interest is pretty important, right? So I don't think that, I think most folks who end up going into real estate, either in investment banking or working for a private equity fund, they will typically, their sophomore or junior years, have had some sort of real estate experience, whether that's with a developer, with an operator, with an investment sales broker like CBRE or HFF or one of these folks. But typically they'll have an experience that demonstrates their interest in the industry and shows us that this is something that you really want to do. So having that demonstrated interest, I think, is really important.
Again, I agree with everything my co-panelists are saying. I think our successful interns treat the 10 weeks as a working interview. So you are taking advantage of every opportunity to sit with senior, mid-level, other analysts to learn about what they do day in, day out, ask lots of really meaningful questions and very thoughtful questions about the work, and show that you are really passionate and interested in the real estate asset. And I think the other thing that we look at is it has to be a really great combination of deductive reasoning skills, but also interpersonal skills, because at the end of the day, if you do decide to take a career path in real estate, you are going to be in front of people quite often. So you need to know how to read a room and to articulate at a very high level to win business, to win clients' trust, to win your team's trust. So I think it's really our real estate people are somewhat extroverted, but they are also very, very smart individuals. So it's for us, it's a very fine line between the mental horsepower and the interpersonal skills to be successful. I think what I always, my go-to advice to undergraduates who are interested in a career in real estate is find out first if your school offers a major or a minor. Take those real estate finance class, learn as much as you can from an academic standpoint that will help you in your interviews and your preparation for for future meetings with different firms. If those are not available, see if there's a real estate club on campus that you can join. I think, by default that you all are here, you are obviously pursuing opportunities with organizations like SEO that can help make those connections too. So just look at everything that's available and at your disposal and definitely tap into it because there are, I find there are a lot of people who claim to be interested in a career in real estate and they show up for the interview unprepared, and we'll move on to the candidate that is better at articulating why their passion is real estate and why they should be the next intern or investment analyst with one of our teams. And finally, I think just being flexible in terms of locations. While we have a very large team here in New York, and across the state line in New Jersey, we have a very large team there. We also have offices in Chicago and Dallas and Los Angeles and San Francisco and Minneapolis and Florida and Orlando. So if you can be flexible with where you will start your career, that opens up a lot of other opportunities for you to work in some really, really interesting teams.
Great, and I will say, shameless plug, I get a lot of emails and interests students who are interested in real estate. So my number one piece of advice is, if you're interested, read this book called The Real Estate Game. It's by a Harvard professor named William Purview. It is an overview of the industry, and it's a quick read, but it will kind of give you a peek into the different areas. And I think from there, you can probably see some areas that might be good fits. So there are mics on the side. If you can just introduce yourself and your school, you can kind of go from there. So that was the first hand right in the back there. You want to stand? Oh. You want to stand up and say your name and your school?
Hi, I'm Christian Alberga. I'm a political economy major at Williams College. So you spoke some about the macroeconomic environment, but I was wondering if any of you could speak directly to how rising interest rates impacts the real estate investing business and what you do differently to mitigate these challenges.
Why don't I take that one? So, it's obviously, your point about rising rates is obviously something that the entire industry is very cognizant about. For those who track the treasuries, it's, interest rates have gone up somewhere between 50 to 75 basis points, if not more, over the last 6 to 8 months. So, interest rates are going up very, very quickly. The impact on real estate typically is in asset classes that are very yield focused, right? So in asset classes like student housing or multifamily, where a big proportion of your return comes from current income, right? So where if interest rates rise, your yield's going to go down, and property prices are going to come down as well. So I think the way that we mitigate against that, right, is typically in the way that we look at investments, we're typically underwriting for that. So in all of our models and underwritings that we do, we will typically project out cap rates. So cap rates are our valuation metric in the real estate industry. And they are effectively the yield that you would buy a real estate asset class to. So for example, if you're buying something for a property for $100 and there's $5 of NOI, you'd be a 5% cap rate. Typically and those cap rates are sized off of a spread typically to U.S. Treasuries. So if you could earn 3% on the U.S. Treasuries, typically real estate yields are priced at a spread to that. So you want to be able to earn something in excess of the Treasuries because it's a riskier investment. And so we are usually baking into our underwritings that yield going up by somewhere between 50 to 75 basis points. So we're anticipating that in our underwriting with the expectation that interest rates will go up over time.
Yeah, another question? Oh, a lot of questions there. Right here in the front. Then we'll kind of move over.
Hi, my name is Dylan John. I am a rising sophomore at Haverford College. And now we talked about interest rates like literally just now. I just want to know what specifically, over your time of being in the real estate game, what has changed and what will impact us in the future. That makes sense.
I can take that one. Sure. I mean, look, I think real estate is a constantly evolving industry. I think the perception that it stayed and tends to be slow moving is accurate until it's not, right? So if you look at the sectors over the last 5 years that really haven't done very well. So one is retail, right? A lot of real estate investors, frankly, missed the whole e-commerce wave. And so we're investors in, B and C regional malls that frankly became obsolete over time. So, they're real big disruptors to the industry that impact how people use real estate that are constantly impacting the industry. So retail is one example. Frankly, I think hotels are one example where in some instances, Airbnb and things like that have had a real impact on ability to drive, hotel rate increases in certain markets. So, I think that there's been a lot of change, and I think that, as investors, we have to be pretty cognizant in understanding where all sorts of disruption could come from. Whether that's technology, whether that's underlying trends about where people want to go and what they want to spend their time and money on, that really, frankly, impact the way that real estate is used.
And I'd just add to that. I would say over the last 10 or 15 years, real estate has become a more accepted asset class. You tend to see a lot of the pension funds and endowments allocating more capital to real estate because of its performance, which I think is a great thing for our industry. And on the institutional level, you got, like the big, leveraged buyouts like KKR coming into the industry. And I think they have definitely changed the industry such that they're able to use information, data, arbitrage to be more efficient, to make better bets, to make larger bets. When you see the Blackstones of the world coming into our industry, and for instance, in Southern California, Blackstone bought, literally 80% of the office stock in the Burbank market, right? That would be unheard of in real estate traditionally 10, 15 years ago, just because you didn't have that access to large buckets of capital, and now you do with more pension funds, endowments, institutional investors recognizing real estate as an accepted asset class and putting more and more money into the industry. And so hopefully that's going to continue to change going forward.
Whoa, okay, you and the, sorry. Oh, you and then.
Hi, so my name is Caffrey Newton, and I currently attend Baruch. So over the past 10 years, we've seen the emergence of an asset class that is quite similar to real estate in infrastructure. In some regard, there are similarities. For example, the tangibility that you guys have mentioned, and in some aspects, two individuals on the panel have mentioned that your firms are invested in student housing opportunities. In some instances, infrastructure that is considered as social infrastructure. I'd like to know what are your firm's views on infrastructure as it relates to real estate.
That's a great question. Look, I think that to your point, there are a lot of similarities, right, between infrastructure and real estate. One is, obviously the yield component associated with both, and frankly, there's a lot of overlaps, right? So We spent a little bit of time looking at cell phone towers, which is an area which would both fall into infrastructure and real estate. We at KKR have a fairly big infrastructure group, and that group actually just closed a $7 billion real estate infrastructure fund. So there is a lot of institutional demand and appetite for that asset class. You know, I don't spend a lot of time in real estate in infrastructure, but I think the general view is, you know, a lot of the infrastructure in this country has been underinvested in over significant periods of time, and there's a lot in terms of what needs to be done. That's sort of one. And then I think in terms of the political environment, you hear, you know, President Trump talking a lot about these big infrastructure plans and how we can sort of activate spending and investment in the space. I think those two factors have driven a lot of the interest in the space. So beyond the investment, the infrastructure fund at KKR, there's certainly a lot of funds out there also raising, you know, very, very large-sized infrastructure funds.
So at PGIM, we have an infrastructure finance team that's part of another business group. So they're providing the capital for infrastructure projects globally. So it is oftentimes the infrastructure investment professionals will collaborate with our real estate professionals because they may not have the experience on the ground to truly understand what's happening in London or what's happening in the Bay Area. So there's a lot of collaboration between our practice groups, but the way we see it is infrastructure is a separate asset, but there is a lot of teamwork between our real estate practice groups and our infrastructure finance team when we go out to provide capital for these types of projects.
And one more question here. Sorry. I'll give you one more question after that.
Hi, thank you for being here. My name is Mohammed. I'm a rising junior at Villanova studying finance and real estate. My question is in regards to how your firms deal with situations in which your real estate projects can possibly affect the community in a negative way. So what is the process in which you guys deal with the community and kind of, I'll give you an example. For example, in Philadelphia, there's currently a renovation of the Suburban Square station, and there's a huge homeless population in Philadelphia. And so how would a firm like yours deal with a situation in which you're trying to not negatively affect the community or create an issue in the city?
And I can probably kick that off. So before I joined SEO, I used to work in real estate development. And I would say that, and you guys can probably speak more to this as well, but the community has a very integral part of any acquisitions or projects. They definitely have a voice and a very active voice as well. So what you will often find if you ever are bored on a Tuesday or Wednesday are attending community board meetings where people such as developers or investors will kind of advocate on behalf of the, their interest on what they think the project should look like, but also take a lot of feedback from the community. So from kind of the zoning all the way to maybe the final look of the building, uses, at every stage, the community has a voice. And I think it's definitely, as kind of underrepresented population, it's up to us to actively voice those opinions or concerns at every point of the stage.
Yeah, I think you hit it on the head, and we tend to stay away from projects that would have a negative impact on the community for a couple different reasons. We'd like to stay out of the headlines, so the headline risk, headline news is a big issue for us. And our capital sources, the NYSTERS, New York Common, CalSTRS of the world, they prefer not to invest in projects that would have a negative impact on the community. And I think we're very thoughtful about that. There are projects that we passed on because the strategy would have called for, pushing people out of their apartments so that we can renovate the units and get a market rate for them, right? We tend to stay away from stuff like that, but we do try and invest in projects that have a tangible benefit to the community. For instance, we're doing a fair amount on the workforce housing side throughout New York, in the Bronx, in Brooklyn. So we are buying workforce housing type projects, not kicking anyone out, but renovating those units, renovating the common areas, renovating the infrastructure of the building, and again, trying to invest in an asset that has a positive impact, but also allows us to make money. And so, for instance, the headline risk and making sure that we're investing prudently on behalf of our investors is pretty important to us.
Okay, and we'll take one last question, Edward, in the back.
Hi, my name is Eduardo Paz. I study economics and finance at Princeton, and I'm currently interning at Morgan Stanley's Real Estate Investing Group. And my question was related back to the topic of the macroeconomic environment that you touched on, Brian. Just considering purchases of portfolios like Blackstone's of LaSalle's lately, and the current market, we're seeing increasing cap rates, decelerating economy. How do you relate that to a purchase like that involves an asset class that typically has turnovers that are, of course, 2 days as opposed to 5-10 years, and depend a lot more on economic growth and the state of the economy?
Yeah, look, I would say I would say that the view of my group is a little bit different from Blackstone's. We've been a little bit more selective in terms of where we've decided to spend our time, which was those sectors that I'd mentioned previously. I think that you see a lot of these larger trades, these large portfolio trades that you mentioned. I think a number of them are in sectors where a group like Blackstone has real conviction. So whether that's, for example, industrial, which is a space where that they've spent a lot of time aggregating large portfolios, or there's been a lot of large multifamily portfolio trades as well that have been big prints in the sector where folks are betting on things like trends like renters by necessity, household formation, et cetera. So I don't think that, I think there's a general trend towards caution, and I think a lot of these portfolio trades tend to be in sectors where folks think that there's some secular growth trend around that space. The other point I'd make is that I think in the last cycle, a lot of these big portfolio trades were made out of buckets of capital that were a lot shorter in duration. So a lot of these big opportunistic funds. Since then, I think that there's been a significant growth in more core plus capital that has longer duration, that is looking to hold for longer and is willing to hold at lower leverage levels, and with long duration on the financing side, meaning that they can hold for periods of time without having to repay their debt, which is what sort of catches you in a bind in real estate, right? And are taking a longer term view towards sectors and markets. So I think it's a combination of those things. It's targeted at sectors that are more secular in terms of their overall growth trends, and then I think that there's pockets of capital that are somewhat different in terms of the type of cost of capital that they're solving for when they make these large portfolio acquisitions.
Well, can we give a round of applause to our panelists? Thank you so much.